bit. Welcome to this webinar. My name is Ali, and VP of Market Analysis and Education at Investflow. And we have a topic today, as a candlestick chart explains. The candlestick charts are one of the very common and popular charting methods. And today I'm gonna just have an introduction to this candlestick chart patterns, and we will discuss a bit detail about the interpretation and eventually the ways that we can analyze the market using these helpful candlestick charts. Okay, but before we go through our agenda, please confirm to me if you can hear me and see my presentation very well. Then we will start without any further ado. Okay, everything is fine, guys? Give me some feedback. I would appreciate if you let me know that everything is fine from your side. Okay, good. Excellent. So before we start, please be aware that all the stuff we're talking about in this webinar are just solely for educational purposes, and they are not part of any investment or trading advice. And as always, I would like to mention that our mission here is to help you to getting the better understanding of the financial markets, to have more profitable trades and enjoy your trading journey, because I firmly believe that trading successfully is not about good luck or chance, and we need to think about what we want to do with our investment and how they will fit into our financial plan. In that way, we just need to learn how to trade and learn the market construction, or let's say market structure, which is very important. So take education very serious, guys, because it's really important to know how it's very important to understand the market structure. Okay, let's see what we have on the agenda. After a short history about the candlestick chart patterns, we will look at the construction of candlesticks, and then we see how to interpret the candles. Then we will demonstrate the interpretation of some of the most popular candlestick, and then eventually we will see how can we analyze candlestick and use them with our trading. During this session, please feel free to ask any question arise and post it to me. I will answer if I know, yeah, of course. And I would appreciate you to join this webinar. And so let's start. Okay, but please note that during the webinar I'm going to turn off my camera to have a better presentation there. Okay, the Japanese candlestick chart. Japanese candlestick chart is one of the few charting methods, very popular. It came it has come from the Japan in 18th century. Another charting method is a bar charts, and also we have the line charts, and maybe if you're familiar with the point and figure, this is another charting method that we know about. So these are the charting method, and it's all started in the 18th century in Japan, which is very popular nowadays in the West as well. I think most of us are using Japanese candlestick on our price chart. The inventor is the Munehisa Homa, a rice trader. Is regarded as the originator of the concept of this Japanese candlestick. He used candlestick chart in the rice future market, which with each candlestick graphically representing 4 dimensions of price in a trading period. These are the construction of the candlestick, which comprises of four dimension prices as a low price, as an open price and close price at each session, the lower and the highest priced, the lowest and the highest price of each session as well. And open price is a price that the trading started in the market, and the close price is the last price when the market is getting close. And between this open and close price, we might see some market fluctuations, that sometimes the price actually comes lower than the open price, and sometimes it might actually go higher than the close price. So the one of the actually best charting method that we have is candlestick charts, because it reveals a lot of information to us by demonstrating these four prices on the chart. And you will see how we are going to use all of these distances between them to identify the market psychology later. So let's have a look at the anatomy of candlesticks. The distance actually between the highest price and the lowest price of each trading session is called the range of the market. It shows the volatility of the market. And then this rectangle here, limited between the open price and the close price, is called body of the candlestick. So we can say each candlestick bar consists of two parts, the body and shadows, this thick upper and lower of this rectangle here. Okay, the body and shadows. We have a body and upper shadows and lower shadows. The distance between the lowest price and the body called the lower shadow, and the distance between the highest price of the session and the body called the upper shadow. But let's see how we can identify the bullish and bearish market sentiment. I'm totally sure that you have seen the candlesticks are actually, they come in different colors. So some of them are have a hollow or body, hollow body or empty body, and some of them actually have the filled body coming in a color. Okay, the candlestick is bullish when we see the close price is higher than the open price. It means the actually market open at this certain price here, and then the buyers overcome the sellers and push the price higher. So we have a higher close price there. It means the buyers had the control of the market, and vice versa. We also have the bearish candlesticks, which comes with this filled body here. It can be any color, doesn't matter, but it's a filled. It means the open price is higher and the close price is lower than the open price. That reveal the market did open at this level here, and then sellers took control and pushed prices lower and closed the session. At the end of the day, the sellers were the winners of the market, so we have the lower close price of this session. But it's not the only information that we can get from the candlestick charts, because you see, by using the distance between the open price and the close price and the related dimension of them on the chart, we can find out which side of the market, the buyers or sellers, had the control of this session or already is driving the market. So because the most important concept behind the candlestick charts is revealing the market psychology, because the market, we have the price always as the outcome of a challenge between the buyers and sellers. sellers. So candlestick charting method has this ability to show us which side of the market is driving the market and has the upper hand. In that case, we can use this rectangle, the body, to identify the sentiment of the market. You know, the market could be on an up run or the rally when buyers are in control, and also could be the bearish or in correction or in crash when sellers are in control. So we can identify first the sentiments of the market, but the range of the day, the total distance between the low price and the high price reveals the whole volatility happened in a session, or the volatility which associates this challenge between the buyers and sellers at the current trading session, which means when we see a lot of volatility in the market, we can have the expectation of changing in the near future, or when we see a strong sentiment in the market, we can be hopeful to see the continuation of the sentiment in the near future. So this is what we are going to use to identify the market psychology, and this is the whole story about the candlestick charting methods, because you will see all of them will come into different names and different shapes, but if you understand the sentiment and the volatility, which it will help you to actually memorize and analyze price chart using only these two concepts behind the construction of candlesticks. Okay, if we want to get into more details, we can say for interpretation of body and color of each candlestick, we can have all of these five actually components. First of all, it's the color of the body. As you saw, when we have a colored or filled body, it means the close price is lower, and then it means the bears or sellers actually are in control of the session, and vice versa. When we have the higher close price, it means buyers are in control. Okay, so the first piece of information that we can extract from the candlesticks is the color of the body, and then we need to take a look at the body range. The body range shows the volatility in the market. We will discuss in more detail later. And then the sentiment, the body range displays the sentiment of each session. And then we have the range, which means, okay, how much volatility involved in the session can we expect to see a sustained move in the market or not? And also, one of the most important parts of candlesticks interpretation is the length of upper shadow and lower shadow. They are very important because the upper shadow and the shadows actually reveal the rejection of price, which means, for example, if I want to show you on the charts, here you can see actually my chart and with a candlestick. As I said before, there are three other charting methods here, as using the line chart and using the bar chart, but the most popular one is the candlestick one. And you can see here on the chart that each candlestick display a session, a trading session. For example, when I use the daily chart, it means I have the open price of the day and the close price of the day. And you see these shadows on the upper and the lower sides of the body here. When you see the body comes in red, it means the close price is lower than the open price, and then you see the shadows here, and then you see the market sentiment is too strong. It's really strong because of forming this long red body here. Okay, and then you see the market sentiment, this bearish market sentiment actually drive market lower in the next session as well. And so this is the first thing that we can actually understand from the body. Okay. And then when it comes to shadows, it's very important to see the place of the candlesticks, especially at the resistance and support levels. For example, you see this is a very long bullish candlestick here. We call it update candle. Then we have a long body and the close price is higher than the open price. This candlestick is called the update. And this candlestick, the red one, which has a close price lower than the open price, is called the down day. When we have this up day here or up day here, and after that we have a candlestick with the shorter body compared to the previous one, it means the market sentiment waned in some way actually. It means the bull run is out of steam, kind of. It shows the exhaustion of buyers, because you see this, here we have a very long body and then we have a shorter body, which means when prices actually open at this level, buyers didn't have enough strength to push prices too high, far from the open price. So they had control of the session, because we see the bullish body here, but the strength was weakening, because they weren't successful to push the price too far from the open price. And then we have the close at this level, which actually resulted in a shorter body. Okay, and then you see this long upper shadow. The long upper shadow means rejection of higher prices from sellers. Everywhere you see that, you can interpret this in this way. For example, here you see after this red candlestick, the bulls back to the market to push prices higher, and then when you see this session with this long upper shadow, it reveals the rejection from sellers. The sellers didn't accept the higher prices. So by the way, maybe at the first hours of this session, buyers pushed the price higher to these levels, but then something happened in the market and sellers took control and rejected the higher prices, pushing prices lower to this close price, which means they are very strong, which means sellers are very strong. And after that, we need a strengthening of the bullish momentum, or we might see the prevailing bearish momentum, which means we have the exhaustion of buyers here, obviously. On the other side, when we see the lower shadows, for example, here you see these lower shadows at this market bottom, which known as support level as well. When we see the lower shadow is longer than the upper shadow or the body, it means the bulls or buyers rejected the lower prices, by the way, and they try to keep control of the market. So the lower shadow always reveals the rejection of lower prices by buyers or bulls. And we expect to see the lower shadows, the actually remarkable lower shadows on the support levels. For example, you see here this shadow, and at the next candlestick and the next candlestick, it means we are at the significant support level here. And so we see these rejections from the buyers have a meaning of maybe strengthening the bullish momentum in the market in the near future, for example, in next days, like here. So this is the interpretation of the upper shadow and the lower shadow. But let's take a look at the interpretation of the range of the market. The range is very important because if you want to be sure that the market can have a very strong movement, first of all, we need to see a strong volatility in the market, because the non-volatile market is a dead market, so we can't expect actually a considerable movement in a dead market when we see no volatility. And to get that, we can just compare the candlesticks to the previous ones. For example, like this, when you see the bearish sentiment is too strong in the market, and we see this range, which is considerable compared to the previous candlesticks, it means that we can expect a lower prices in the next session. That's which actually happened. Okay, but when I see a very less volatile in the market, this is a sign of indecision in the market, guys. It means the buyers and sellers are negotiating on the price somehow, because the sellers think they don't have enough strength to push the prices lower below this, for example, support level here. And also the buyers are not that strong to take the whole control of the market and push prices higher in the session, which means that they are negotiating on the price, and somehow it's not a good time to enter the market maybe. But also indecision candlesticks reveal that we can expect some movement in coming sessions, because when you see the market there is no considerable volatility in the market and price fluctuation, we are in a kind of a balance or consolidation, and then we can expect this consolidation as the very beginning stage of happening some big movements in the market. In that case, we can wait to hunt a trading opportunity, maybe to see which side of the market will be able eventually to get control. And then the candlestick body color shows us the correct market sentiment, which means we can expect the market to move in that direction for a while, for some time. Okay, back to our presentation. That was the interpretation of body and color, which you see we have the long body and the short body. The body reveals the strength of one side of the markets. When it's white, or let's say it reveals the bullish sentiment of the market, and then when it's the actually black, it reveals the bearish sentiment of the market. So it's very important to compare the bodies to each other, because when you see the actually short body, it means the sentiment is waning. Okay, and when you see the longer body, it means the market sentiment is prevailing. So that would be a chance to continue for some time in the current direction in coming sessions. And also the range of the market that reveals that we are in a consolidation phase, or there is a negotiation between the buyers and sellers, and there is a lack of momentum in the market, which reveals the indecision phase of market psychology. So in that case, it's better to stay out of the market and just watch which side will eventually get control. This is a low volatile market, and this is a high volatile market. A high volatile market, for example, during the news announcement, if I go to 30 minutes, for example, time frame GBP AUD, you might see this candlestick here comes with this actually very long body there, and these shadows, which reveals a very volatile session okay, compared to the previous ones. You see, after each consolidation, we can expect this some big move happens in the market. This is an important part of interpretation of market psychology, because you see, after these short body candlesticks, doesn't matter in which actually sides, the bullish or bearish, no, it's not important. But after this consolidation, we see this very aggressive movement to upside. It might be caused by a news announcement or something, but we don't care about that. The thing that is important to us is that this long body here means buyers push prices aggressively in a 30 minutes session, okay, and then after that you see a very remarkable reaction from the sellers, and then you see the price back to this balance actually level here around 1.85, for example. Also, we have some things here after a bit consolidation. You see actually the buyers push prices higher there. Or you can see here after this indecision candlestick that we discussed, this upper shadow reveals the exhaustion of buyers, and it means that it reveals the rejection of higher prices from sellers, and then eventually they took the control of the next coming sessions and push prices lower. And then after that you see this lower shadow here. So this is the way we can interpret the market psychology using the candlestick charting method, okay. But it's better to use all of these candlesticks in conjunction with other tools of technical analysis tools and price action. For example, using this with the Fibonacci levels or the support and resistance levels. To learn how to analyze the market, first of all, we need to understand this, let's say, the concept of the market psychology behind each candlestick. Okay, guys, are we cool? If you have any question, please just write it down to me. I will get the answer as soon as possible. Okay, everything clear? I hope so. Okay, shall we continue? Okay, let's back to the presentation, and after checking the long bodies, let's see one of the specific forms of candlesticks or dojis, where dojis actually happen on the chart when we see no change between the open price and the close price, which means the dojis actually occur on the chart when we see the market getting close at the same level of it's actually opened in the beginning of the session, which means there were no sides be successful to take control of the market, and we are in totally balance. So the Doji's psychology is indecision for sure, but we have a different types of dojis, and dojis don't reveal any direction of the coming session, okay. They just show that the market is at the level of balance, so there is no enough power in any of the on each side to take control of the market and prevail a sentiment in a specific direction, as a bullish or bearish. We have the gravestone doji. When we see a doji comes with a very, very long upper shadow, we call it the gravestone, and this it means the market did open at this level, then buyers push prices higher to that level, but they couldn't keep the market at this level, so they lost the ground, and sellers pushed the prices back to the same level as the opening price at the beginning of the market, with some volatility on the downside, which means they tried to get the control and push prices lower, but buyers we're not that weak to let them to do that. So we see the close price at the same level of the open price, with this long upper shadow that reveals the gravestone, and it means we have a very significant rejection from the sellers, but the market is in the balance, so they are not strong enough. In that case, we need to see to get the clear direction from the price action. We need to wait and see the next a candle to see if the market sentiment can prevail in one direction or no. And also we have the long legged Doji, which means the complete indecision in the market, and this is the situation that we should get out of the market, be out of the market and just watching the market, because Dojis, long leg Dojis means not even buyers and sellers didn't have enough strength to control the market. Also, they made the same volatility on each side. It means the rejection from the buyers was almost equal to the rejection of the sellers, and these close and open price are on the same level. Happened in the between of the range of the market, which means the market totally is in balance. And then we have the dragonfly, when we see a very significant rejection from buyers to accept the and they didn't accept a lower prices, and but also they didn't have enough momentum to push prices higher, but they just could close the price at the first stage or the opening price. These three types of dojis reveal a very volatile market. You see, they reveal a very volatile market. But we also have a doji star which a very short range, as well as a nobody here. We have the same open price and close price, and we also have a very small range here, which means there is a lack of participation in the market. This is a totally different interpretation of a session, which means for example, you may see this kind of doji starts at the end of a trading session, especially the US trading session. You know, for example, at 11 or 12 before closing the market, you see some doji stars coming with a very short range that reveals there is not a lot, let's say, interest in the market at that level or at that in that time. Okay, which means we have a lack of participation, and also there is no strength in one direction to keep control the market. So these are a very popular types of doji stars, but let's practice them on the charts. And I'm gonna show you, when you see a long body in one way and then a long body in the opposite way, don't confuse, okay? Because all the time you can combine the candlesticks together. For example, in these 30 minutes, if I want, we can find some good doji stars, a lot of them. You see, for example, this is a long-legged kind of doji. You see a very short body here, and the close price and the open price are almost the same, and also we have these long upper and lower shadows on each side. So it means we are in the indecision phase, and after that we see a bit movement in the market, but with a less volatility compared to the previous one. Also, we have another doji here. Let me zoom in a bit. You see, when you see two dojis coming after each other, it means the market is in indecision phase, so it's better to wait to see if the one side can overcome and take control. For example, you see here, this is another long leg doji coming after this dragonfly doji. See, so dojis are the one of the very common actually candlestick types. And also you can see here something like Doji star, which means we see the open price and close price are almost the same, and then we see a very low volatile market. So in that case we can expect to see maybe a momentum in one direction prevailing. But how can we use these candlestick charts as a trading strategy? One of the popular way to use these candlesticks is using them at the level of support and resistance levels. Okay, but first let's see how we can identify the support and resistance levels. For example, here you see GBP UT 30-minute time frame, and you see we had a very beautiful downward movement here. And at the first step, we can draw a trend line, a downtrend line like this, and then we see the momentum is gaining, the bearish momentum is gaining, and we are a bit more or a steeper downtrend here as well we can have. Okay, you see this level, for example, something like this. Okay, but we know as a rule that broken trend line will change the rule, its role actually. When we know, for example, this downtrend line is known as a reliable resistance level, and then when it's is broken, we see that it can change its resistance actually role to be a support level. Okay, so a broken downtrend line is considered as a support level. And you see, when the price hit this support level here, some rejection from sellers, from buyers occurred on the chart. You see that? It means we have a rebound from the reliable support level. If I zoom in a bit, you see, for example, it was a downtrend line, and it was our primary downtrend line. And first of all, we see this breakout here. Okay, and after this breakout, finding some top at this level, forming a resistance level for us, and then we see the prices actually continue to decline to this broken previously resistance level, which is a support level now. And then when you see this shadow, this lower shadow here, as I explained, we can actually take it as the rejection of lower prices from buyers. So then after that, we can call it a rebound from the support level. So when we see this lower shadow here, kind of remarkable at the same size of the body, after that, we can expect to see some movement upside, which means buyers, which means this actually session opened at this level, then buyers try to get this high, but at the moment they weren't enough strong to get the market at this level. So sellers took the control, pushed price lower to this level, but the buyers were at the market actively, and they rejected this level as the support. because, for example, at this level as a support level, some buyers found it interesting to jump on the market, so they opened more buy positions and they pushed the prices higher to this level, and eventually market closed at this level. And after that, more buyers ran in the market and pushed prices higher. So in that case, we see this rejection, and this candle here can confirm this rebound from here. So we can find a good buy entry point at this level above the previous session's open price here, for example, above the body of this at this first candlestick here. We can find a buying entry with a very, very good risk reward ratio, or let's say the risk management, because if we enter the market at this level, let me change the color, change the shape to this. For example, I could put my stop loss there, and then I can consider the 1-to-1 risk to reward ratio at this level. And that's it. That would be a good risk reward ratio for me. Okay, so this is a rebound analyzing. It's not only the trading, it's also the analyzing the market. And so let's go to another one. For example, the Euro USD, the live market now. Okay, you can see here on the 30 minutes chart, something interesting happened. I'm going to show you how you can analyze the market only using candlesticks, nothing else. No indicator, no actually oscillator, no nothing. But just using the candlestick chart to get the right psychology of the market. For example, you see here, after coming down in this at these levels around the 1.1320 2022, we see this shortening body reveals the sentiment of the bearish sentiment is waning. Okay, and then we see this very short range means the volatility in the market is less than the previous sessions. Okay, which means we are in a kind of indecision phase, or there is a lack of momentum to continue market down. And after that, we see this market bottom here. We know market bottoms are or price bottoms during the trends are significant support and resistance levels. Okay, so after that, a rebound that I explained before, you see the rebound from here by making another shadow and very, very less volatility. You see still less volatility in the market, and then you see the bullish momentum is gaining by making these longer bodies here, and after that a bit decision, and then this longer body. But you see at all of these 2-3 hours of trading, you see this level of 1.13215, for example, or 22 holds a support for us, because you see this candle and this candle and this candlesticks are trying to get to reach this level, but then some kinds of rejection happened in the market by buyers, and then we see the prices went higher. Okay, so I can see this rejection here, so I can rely on this support level as a reliable support level. And also I have this previous top here, and see the market reached levels above this actually market top here, my previous top here. And you see at this level as a broken resistance, I can expect it to act as a support level, and these shadows reveal that the market is trying to reject the lower prices and hold this support, this higher support at this level. Okay, and it means even though we have this bearish body here, it means the buyers are trying to maintain the control after this long up session here. You're trying to keep the control. In that way, I will not trade this market until I get a clear confirmation from the price, the candlestick, or maybe using one or two oscillators to see if this support will hold or will break. So this is the way that we can use it. For example, you see after this long bearish body here, sellers are in charge in the current session, and they already made a lower low in the market. So it's probable to see a break of this level. So this is how you can analyze the market using the candlestick charts. In this case, if I want to trade this setup, the conservative way is to wait until I see a clear break above this high as the last actually top as a resistance. When I see the market actually clear this resistance, I can hope to see the higher prices by bullish momentum gaining. Otherwise, if I see a clear break below this support level here, then I can put my stop loss at this high, and then I can take let's say the sell position. If I find out a clear evidence, a clear actually confirmation that evidence the breakout below this support level here. So this is a very let's say a simple way to understand the market structure. But by the way, you can see here that as long as we have these higher tops and higher bottoms in the market, we expect the uptrend in the market, and you see that but the sellers are trying to break below this support level. So we can see a correction down, and then a rebound will occur maybe in the market, and then we see the uptrend continues. Okay, for now I think it's enough for now. Okay, very good. Thanks a lot for your participation in this session. I hope you enjoyed. Wish you a great weekend ahead. Thanks a lot. Have a good day. Bye-bye.